Good day, students. We are treating the topic today is the final accounts of a sole trader, SS1. But before we go further, I want to explain to you who is a sole trader. A sole trader is a business organized by one person. A sole trader is a person that owns a business with the main aim of making profit. Sole trading is a business established and controlled by one person. He or she owns this business, so he controls, manages, and takes all decisions on his or her own. In doing that, that means all the profit and losses as per the business goes to him or her. It is a type of business in which one person provides the capital, bears the risk, and takes full responsibility of the firm. Now, look at the word. It takes, he or she must have borrowed that's the money, that's the capital, or borrowed it, or saved. So in that case now, in any way, must have derived the capital, he owns the business. So it takes full control of the business. What concerns us in accounting is are the accounts involved in this type of business. In this business, 3 accounts are mostly needed. 1, the trading account, P&L account, and the balance sheet. Now, you can see on the board the format of the trading account. The format says, now, on the debit side, we have the opening stock, purchases, carriage inwards, returns inwards, and so on. But I will now take time to explain each of the terms here under the trading account. We have the opening stock here. What is meant by opening stock? Opening stock here is the stock of goods available for sale at the beginning of the trading year. At the beginning, what he or she has at the beginning of the year is meant by opening stock. Then you see here purchases. Purchases here. Here now is the total goods purchased for sale. The goods purchased there are meant to be sold, not to be kept in his warehouse. So then we have here what is meant by carriage inwards. What is carriage inwards? Here now is that's the cost incurred by the owner of the business to bring the goods purchased to the store. These two are added together to give you figures there. Then the next thing is you can see when you purchase goods, some of the goods may be returned. So in that case now, what do? Any goods returned must be deducted. So you have less returns inwards. Return inwards here means goods earlier purchased there, now returned due to reasons known to the owner of the business. So when you now less that from here, you have an amount here. That's why it's being by X. Then we have less goods withdrawn. Here now, some goods will be withdrawn by the owner. That is here we have either less goods withdrawn or goods consumed by fire. Goods withdrawn here, the owner here must have eaten some of the goods. So in that case now, any goods withdrawn here by the owner or destroyed by fire must be deducted. So after doing that, when you subtract goods withdrawn here from what we have here earlier, we give you an amount here. So you now add opening stock here plus the total you have here. We give you what is called the cost of goods available for sale. In short, COGAS. Cost of goods available for sale. So these two here now, you add your opening stock plus what you derive here. We give you your COGAS. Then having derived that, the next thing you now do is you now subtract closing stock. What is closing stock? Closing stock are the goods left unsold, which were not sold in the year. So that is deducted. Then you have what is called cost of goods for cost of goods sold. Here now, here is a cost. Cost means cost of goods sold. Cost of goods sold, that's the goods actually sold in that year. After you have made your sales, then goods withdrawn, carried in was what you are bound to get is a cost of goods sold. That is being given here by X. Then what next now? You now go to the now all what I've explained now are items debited in the trading account. Then you have on the credit side now. Here you have sales. What is sales? Sales are the actual goods sold by the owner of the business in a year. After you have made your sales, some of the goods may be returned back to the suppliers due to reasons known to you. Then, in doing that, you must subtract the goods returns outwards from the sales made here. So after doing that, you have an amount here being given by X. Then, after you have gotten that, this is called net sales. That's the actual goods sold. Net sales. Net sales here is the actual goods sold by the business owner. After deducting your returns outwards from your sales, you have your net sales. So you now subtract your COGS here. That's the goods sold actually from the net sales. That will give you your gross profit. Now, the main purpose of preparing this account, called trading account, is to get the gross profit. The gross profit is derived after subtracting your net sales from your cost of goods sold. There you have your gross profit. Now, gross profit is prepared mainly to derive your trading account is prepared mainly to get your gross profit. Gross profit is the profit made by the owner of business, which he cannot keep in his pocket, because once that is done, he has abused the account. So in that case now, the gross profit is derived when you prepare your trading account. Okay, now in this case now, that's the first account a sole trader is bound to prepare. He prepares the trading account. After that is done, you now move to the what is called P&L account. Here now, let me just tell you again. When preparing this account, you must take note of two things: opening stock and other items here. Other items here are called income received. When you get your income here now, when you get your income on the credit side, from there you now subtract from your expenses. That's the trading account expenses. You get what is called gross profit. When preparing your trading account, you must take note of some items here, like the cost of goods available for sale and your COGS. These two are derived from the expenses you have taken care of. Now we have here purchases, carried in was, and mind you, the format here is just to guide you on how to prepare your trading account. In some questions, some of the items here may be missing, but once you get the format ready, the format here is to guide you on how to prepare your trading account. In some questions, some items will be missing, but once you have known the format very well, you get your answer as expected. That is a trading account given to you, and I've explained all the items. All these are called terminologies: opening stock, purchases, carriage inwards, returns inwards. Returns inwards, earlier explained, means goods earlier purchased there now returned back due to reasons known to the buyer. Then goods withdrawn here may be goods stolen, destroyed by fire. You have to deduct all those ones because they will not count at the end of the year. So in doing that, eventually you get your gross profit here. Now, let's now move to the other account, P&L account. After you have derived your gross profit from here, I said earlier, gross profit is derived from trading account. What we have done here is called trading account. But for the P&L account, you have to subtract all the expenses from the gross profit. That will give you what is called net profit. Net profit. Now, the question now is why do you prepare net profit? Net profit is prepared so as to get the actual profit which the owner of business can put in his pocket. When preparing P&L account is prepared solely to get your net profit. Take note, we prepare P&L account so as to get our net profit. Net profit here is the profit derived from the P&L account prepared. Then, when preparing this account, you must take note of all the expenses incurred by the owner of business. When doing that, after you have subtracted all the expenses, you are bound to get your net profit. Then finally, balance sheet. But before that is done, under this account, there are some major expenses here which are called accrued income and prepayments. In doing that, you must take note of what is called adjustments in the account. But before we go to that, let me explain something to you. In the net profit, we have the two sides again. We have the debit side and credit side. On the credit side, you have here gross profit derived from here. Here we have a CD carried down, then being brought down here finally. Then here we have other income. Other incomes like rental income, discount received, and so on the credit side. Then on the expenses side there, all the expenses incurred by the business owner must be written here. That's the debit side of the account called P&L account. All the expenses incurred, then with depreciation must be debited. From there, after adding together all your expenses, you now subtract them from total here on the credit side, you get your net profit. So I think that is all for now, but before we go further, let me just do a summary of what we have said so far. I said trading account is prepared solely to get our gross profit. Then the P&L account is also essential for the sole trading business. The sole trader for the P&L account is prepared solely to get the net profit. How do you get the net profit? Is by subtracting all the expenses on the debit side from the income on the credit side. From there, you now get your net profit. So finally, in our next class, we treat balance sheet and adjustments in the account. In our next class, by God's grace, we go through the adjustments in the P&L and the balance sheet.